Hi students, yesterday we have discussed about the types of markets, that is financial markets. Today we have to look after the capital market and money market. We have already finished, so we'll be looking at capital market, what are the types of the capital market, and then we will be discussing in detail how the capital market functions. Okay, so let's start without wasting time. But before that, let me recall what all we have learned in the previous class. First, we learned what is financial market. We learned that it is a place where the financial assets are created and exchanged. And then we learned that the financial market has many features, like one of the most important feature was it helps to convert the savings into investment. So that was one of the important features. Then we learned that there are two types of financial market. One is money market and the other one is capital market. And we learned that the money market is controlled by RBI. The money market is controlled by RBI, and capital market is controlled by SEBI. And we learned the instruments which are dealt in money market. The instruments which were dealt in the money market were treasury bills, commercial paper, certificate of deposit, call money, and commercial bills. So these were the instruments which were dealt. And we learned that treasury bill is something which is issued by the government of India. And we learned that call money is something which is between two commercial banks whenever there is a need to maintain the cash reserve ratio. And we learned that certificate of deposits are issued by banks whenever they feel that the recurring deposits and fixed deposits are not giving enough money to them. Then we learned that if a trade bill is discounted with the bank and when the bank approves it, then it is called as commercial bill. So now today we will be looking minutely into capital market. So first let us understand what is capital market. See, capital market, we learned yesterday that money market is meant for short term. What is short term? The period which is less than a year. But now we are focusing on capital market, which is for long term finance. Remember, we are looking at for long term finance. And here what is meant by long term? Long term is a period which is more than a year. So whatever securities which are dealt here, that will be for a period more than 1 year. Whenever a company requires a finance for a period which is more than 1 year, so to which market it will approach? It will be approaching to capital market. For example, a company like to acquire another company, a company like to purchase a fixed asset. So there are various reasons for which you may need long-term finance, or you want to diversify your business. In that case, you will be in need of funds. So those funds can be obtained through this market, that is capital market. And as I explained yesterday, I given a glimpse of that yesterday, that is the capital market is subdivided into two parts. One is primary market and the next one is secondary market. The first one is primary market and the second one is secondary market. Now question arises, sir, what is primary market? As I explained yesterday, this is called as a fresh issue market. It is called as a fresh issue market. So what is meant by fresh issue? Remember, here the investors will be directly buying their shares from the company. no middleman. Okay, so this is called as fresh issue market. Now fresh issue means directly you are buying it from the company, that is called as fresh issue. Then the second one is secondary market. In the secondary market, what happens? You are not directly buying it from company. You will be buying it from an existing shareholder. For example, I will tell you. Honda company, you are well aware of this company. Honda issues shares. Now, when Honda issues shares, those shares were bought by A, B, C, and D. And after it closed issue, A was in need of funds and he sold his shares to X. And this need to be done through a proper channel. We will discuss later, but simply I will tell you that A has sold his shares to X. Now what we can say is A, B, C and D acquired the shares through primary market because it is a fresh issue market. They have directly purchased them from the company. But whereas the secondary, we can say that X acquired the shares from A through the secondary market. We can also call it a stock exchange. Okay, so here an investor will buy from an investor. You can say an investor will be acquiring shares from investor. Okay, so this is what secondary market is. We will discuss about secondary market later, but now I will let our entire focus be on primary market. Okay, so in primary market, question arises, how shares will be issued to the public? The question arises, आप shares को public को कैसे issue करते हैं? How you are going to issue? So there are 5 alternatives which are available to the shareholders. Company. The 5 alternatives available to the company. So let us see which are those alternatives and what does they mean, or how the shares will be issued under those methods. If you have completed the company accounts chapter in your PUC second year, you can understand this properly. Chalo, let's start. So the first method of acquiring the share is, or acquiring the shares is, the first one is offer through prospectus. Offer through prospectus. So what is meant by this offer through prospectus? It is just like you take admission into any college. It is like that. First you need to buy, company will issue a prospectus. Remember, prospectus is not offer. It is an invitation to offer. That means the company issues a document called as prospectus and tells us that, oh, you come and you offer to buy our shares. Okay, so under offer through prospectus, a company issues prospectus which will be containing an application. You need to fill up that application and apply for the shares, and later allotment will be done by the company. And you need to pay the required amount, and you need to pay the required amount. So this is how the first method, that is issue through prospectus, takes place. And this was one of the widely used method, but nowadays it is not being used. Okay, so but this is one of the well discussed mode. Okay, so then see, this is possible. For example, this method is possible for the one who is having high credibility. You are existing, you are already existing. That means the promoters who are promoting the company should be well known. At that time, people will be interested to invest in your business. So it is good at that time. Otherwise, you need to go for the second method. And the second method is offer for sale. Offer for sale. Now question arises, sir, what is offer for sale? Sometime when the company is not that well known company, and whether it is having like it is in a dilemma that whether people will buy or not, how the response will be, they are not aware. At that time, they ask, there is an arrangement called as underwriting. They ask a broker company to sell their shares. So that is called as offer for sale. It consists of mainly brokers. Okay, so these brokers will be selling our company's shares. So this is called as offer for sale. Then the third comes when the company don't want to be part of the primary market, and don't like to go through this prospectus and all, because it is a costly affair. Because printing of prospectus, applications, collecting of money, appointing a person to collect all those things requires a lot of efforts as well as money. So when the company don't want to fall in all these things, then what it does is it likes to go for the third method, that is called as private placement. What is private placement? In this, the company will issue the shares to few people whom it knows, or few people who are interested. So there will be no public issue. They don't want them to be involved in all these things. So that is called as private placement. Okay. So the first one is offer through prospectus. It is done when a company is a very well-known company, right? Or company will not be a well-known, because as it is entering, so the promoters should be the one who are well-known in the market. So the next is offer for sale. This is generally done when the promoters are new, but the idea is good. So some broking company may agree to sell their shares. Then private placement. I have already told, like, what is private placement? It is the arrangement under which the shares being offered to only few people. Okay. Then the next comes the fourth one, which is right issue. It's called as right issue. Now, what is right issue? In order to understand that, you need to go into the deep depth of it. So now, what is right issue? Right issue is an arrangement. It is applicable to that company which is issuing shares for the second time. Okay, for the second or the third, fourth time. It is not applicable for the first time. So when you are issuing the shares for the second time, remember the rules says that the shares should be first issued to the existing shareholders. Remember what the rules of the company, what the company law says. When you are issuing shares for the second time, it is the right of the existing shareholders to get first opportunity to buy the shares. So when you try to adjust the capital required, or when you try to collect the capital required from the existing shareholders only, then it is called as right issue. It is called as right issue. And right issue and the bonus issue are the two wonderful concepts. Bonus is not there at this moment, so don't worry about it. We will discuss it in account. But right issue is something which is associated with the existing shareholders. So there, the new issue should be first made to the existing shareholders, and if any shares remains unsold, then it will be issued to the public. Then the last one is EIPOs. Remember, if you want to carry out this process with the help of electronic mode, then this is called as initial public offer. Okay, that is called as IPO. Okay, so this is an agreement, remember, which need to be made with the SEBI if you want to issue shares by electronic mode. Remember, if you generally it will be issued physically. That means you need to print prospectus and all, but now you don't like to go physically, you want to go online or in the electronic form, then definitely you need to make an agreement with the SEBI, and now that is known as initial public offer, under which what you need to do is you need to appoint a SEBI registered broker who will be accepting the application. Earlier you were doing all those things physically. Now you need to appoint a broker who will be accepting the application, right? So those what all associated things will be done by this broker. Okay, so then you need to also appoint, that means a company also need to appoint a person to look after the work of this issue. Okay, so then next is one more thing what you need to understand here is, once you issue shares through a stock exchange, for example, I will tell you, if I make this primary issue through BSE, that is Bombay Stock Exchange, that means it means that you cannot you cannot list, that means in secondary market you cannot choose the same stock exchange, you need to go for another stock exchange. Remember, so if when you want to list your what is mean by listing? Listing means registering your company on the stock exchange for the secondary market. So when you are registering your company for the secondary market in the stock exchange, you cannot opt for the one which you have already chosen for the primary issue. Hope you are able to understand that. Next is, we came to know about this primary and secondary about primary market and its issue. Before we move to the secondary market, I like to bring out the difference between money market and capital market, and then we will go to secondary market. So now the difference between the capital market and money market. You can understand them very easily if you study both well. So the number one is participator. One thing you need to understand is, in this participation, almost it has common, but in the money market, individuals are allowed, but generally individuals will not participate. So in money market, in secondary money market, individuals can participate, but still there is no active interest of the individuals in money market. Okay, so here also there will be banks, financial institutions, companies, and public. And here public will not be included because rarely we find financial institutions and companies. So these are the participators of capital market and money market. Then when it comes to the next point, that is the instruments which are dealt. The instruments which are dealt, remember, in capital we deal with shares, debentures, government securities, etc. But in money market, as we dealt yesterday, if you remember, we trade in in trade bills. Oh, sorry, treasury bills. Sorry, treasury bills, commercial bills, commercial paper. Okay, then next is call money and certificate of deposit. These are the instruments which we deal in money market. Then next is investment. We call it as investment outlay anta. We call it as investment outlay. Remember, the amount you need to put in capital market is generally a small in number. You can see if you have studied the issue of shares chapter, you can see that there is a less amount of outlay because you can invest even 10 rupees, 100 rupees. If you see the price of the shares will be 10, 100, 50, 25. So you can invest with a smaller amount also. So even a less capital, with a less amount, you can enter into this market. But whereas in money market, it is high. For example, if you see treasury bills, they will be issued in the multiple of 25,000. The minimum amount you need to pay is 25,000 and multiple of that. So you can understand that here you require, there is a high capital outlay, but here it is less capital outlay. Now the next is duration. We know about this very well. Duration. In capital market, the capital market is meant for long duration investments, and here in the money market the duration is short because it is meant for a period which is less than a year. Okay, so once again let me tell you all the points once again. Here the participants are bank, financial institution, companies, and public is very important. Okay, but here you will find all except that public, and even you can add, if you want, RBI is also part of it. Okay, and even here the SEBI is the one who monitors the entire capital market. Next is the instruments which are dealt in the capital market are shares, debentures, government securities. But whereas in money market you will find treasury bills, commercial papers, call money, and certificate of deposit, which we have discussed yesterday. The next is, here the investment outlay is less, but here it is high. The next is duration. In capital market there will be only long duration investments, and in money market it is only short term, because they are meant for only short term only, and capital market is always meant for long term finance. The next is liquidity. Both are liquid, but when compared, money market has high liquidity and capital market has low liquidity, because here there will be already an agreement and these are for short time, so they have high liquidity. But here it is liquid, but compared to the money market it is low. Next is safety. Remember, from safety also, the money market are highly safe. The reason is because of the duration. That is very important. If because of duration they are considered to be highly safe. The reason is you can predict the future of a company for a year. Very easily you can predict. But it is very difficult to predict a company's future for the next 5 years, 10 years. And you know that these investments are meant for that time. So here the safety is less compared to money market. Okay. Then the next is return. Next is return. Return means the amount you are going to, sorry, the interest or the dividend what you are going to get back from your investment is here, it is called as return. Consideration हम बोलते हैं, something quid pro quo, something should be in return. Okay, so here in capital market you will get high returns. Why you are getting high return in the capital market? Because your waiting period is also high. The more you wait, the more return you will be getting. And the money market, as it is for a very short time, right, it will give you a lesser return, or you can say the low rate of return. Okay, hope you understand the reason why you are getting high interest here, because the investment period is also high. In money market, why you are getting low interest? Because you are investing it for short period. Okay, so generally that's why when we are talking about SIP, that is systematic investment plan, the financial advisor always tell you to invest and don't look at that investment for 8 or 10 years. The more you wait, the more will be your returns. Okay, so now hope you have understood this. Then next we will move to the secondary market. Okay, so before that let me erase. Now the next is secondary market. Okay, secondary market is a market for existing securities. You need to understand that it is a market for existing securities. Existing securities, or you can call it as second hand securities. Second hand securities. Existing securities, or you can call it as second hand securities. Okay, so now you know that this is another, like, even this can also be called as stock exchange, because stock exchange is a synonym to the secondary market, and this market is regulated by SEBI. This market is regulated by SEBI. Okay, and they are the contributor, the secondary market are the big contributor to the economy. And I will tell you, every day when you hear the word Sensex and Nifty, these are the most discussed terms in the news channels, especially the CNBC, NDTV Profit. They discuss more about this Sensex and Nifty, and whenever we are talking about the economic status of the country, we will be again discussing about these two terms. One is Sensex and the Nifty. What they are the indexes. They are the indexes, and these are the index of, this is index of 30 companies and this is the index of 50 companies. It shows how the stock market is performing in the country, and remember, this is the economic barometer, right? The stock markets are the economic barometers, and the stock market shows how the economy is, whether it is in a good state, whether it is in a bad state. When it goes up, we say that the economy is doing fantastic. When it comes down, we say that the economy is coming down. Okay, there will be a discussion, panel of experts, they will be discussing why. Remember, every single event which is happening in the country decides how the Sensex will be and how the Nifty will be. Okay, a small example which is outside the textbook, I will give you how these are affected. Okay, now if there is a heavy rainfall, even that affects the Sensex and Nifty, because if there is heavy rainfall, the crop will not be good. If the crop is not good, then the sale of fertilizers will be less. Then if the sale of fertilizers is less, then all the companies which are fertilizer companies and which are there in the Sensex get affected. And when the farmer's income is low, then even they will not be ready to invest in the stock market. So every single economic activity which is happening in the country is directly or indirectly influences this Sensex and Nifty. Okay, so now moving ahead, let me start with stock market or the stock exchange. Now let me tell you why it is called as stock exchange, because most of the students will not be able to understand why it is called as stock exchange. Now, if somebody asks you what is stock exchange, most of the people tell that it is the place where the shares are bought and sold. It's not just shares, it is the shares, debentures and government securities. Okay, and there are other documents also. Other securities also. Now, why instead of shares, debentures, they have given this as stock exchange? Let us try to understand why it is called as stock exchange. Remember, the price of a share will be 10, 100, 50, 20, whatever it may be. And the one who buys share will get a share certificate. What he will get? He will get a share certificate. Assume that I have bought a share worth rupees 20. One share I have bought. And they need to issue a share certificate to me that itself would have cost them 6 to 10 rupees. So to buy one share, you are again spending, to get payment of one share, you are spending again 5 to 10 rupees. And other than that, this 10 rupees, you will be incurring many costs like maintenance and all. So at that time, what they thought is, we will not allow one to buy a single share. The one who likes to buy shares should buy at least 25. Should buy at least 25. So now you cannot carry a single one. You can carry minimum how much? 25. So try to understand, when you carry 25 into 20, it becomes a bundle of 500 rupees. Or you can say, you can call it as a bundle of 25 shares. Okay, so when these bundles are sold and purchased, remember, there is no individual share which is being dealt here. It is what we are selling here. We are selling bundle and we are buying bundle. So these bundles of shares were referred as stock. If you ask somebody what is stock, stock is a bundle of shares. Remember, stock is a bundle of shares. So when these bundles are exchanged, why should we call it as shares exchange? They called it as stock exchange. Clear with this point? Because most of the students will not be able to understand why it is called as stock exchange. Because here, not individuals, here the bundles are exchanged. Okay, next. So now, what is meaning of stock exchange? So I like to quote a definition as it is there in the textbook, because definitions are something which need to be quoted as they are. Meaning of stock exchange. According to the Securities Contracts Act 1956, remember, according to Securities Contracts Act 1956. It's a wonderful definition. Try to understand. I like to make you understand the three terms which are given here. The first one is, what it says is, stock exchange means any body of individuals. Remember, any body of individuals. That means it's not a single person. It is a body of individuals, and not necessary that that body should be a registered one. It says the incorporated or not. Body of individuals, incorporated or not, constituted for the purpose of, constituted for the purpose of. Number one is assisting. The next one is regulating. And the next one is controlling. So these three things should be done by that body of individuals. Then remember, that will be called as a stock exchange, right? So now you can see what it says is, stock exchange means any body of individuals, whether incorporated or not, constituted for the purpose of assisting, regulating or controlling the business of buying and selling of securities. They should be doing all these things, three things for what? Buying and selling of securities. Now let us understand what is meant by assisting, regulating and controlling. For example, if you are a new investor, you don't know how to open a demat account. You come to me, you approach to the stock exchange. I will assist you how to open that, how to buy shares, how to make settlement. So that is called assisting. The next is regulating. What is regulating? If I allow everyone to come and trade, there will be some malpractices. So what I do, in order to have a free, fair trade, what I do, I start making rules, I start making regulations. So that comes under regulating. And after that, if somebody is crossing the border or if somebody is going beyond the regulations made, then the third thing what I do is controlling. So a stock exchange does these three things, that is assisting, regulating and controlling. Okay, so hope you have understood, right? And remember, which act defines? Securities Contracts Act 1956. Okay, so now the next is, after this, the next is, what are the functions of stock exchange? And now this part we will discuss in the next class, because first you go through all these things, then we will be looking at the functions. So once again, let me clear you. Secondary market can also be called as stock exchange. Okay, and this stock exchange will help you in assisting, regulating and controlling. Okay, so tomorrow we will meet. Thank you.